Thanks for joining us here on the Professional Edge. My name's Todd, tax attorney, CPA, and certified financial planner. And what we're talking about is investing, what you might need to know. And what we need to know is what can we do to actually protect our investment portfolio from market swings, market volatility. Well, here's one thing we can do. We can sell everything off and move to cash. Not sure that's the right strategy, but we all know that cash in the bank is FDIC insured. There is no risk of loss. But with inflation at 2.5%, 3%, you're getting less than 0.5% return. You're basically losing money very slowly. So that's probably not the overall strategy, but we all know we need some safety cash, our sleep at night money, as I call it. And that protects our capital. The next thing we can do is actually buy an insurance product. Okay, that's the bad word that we talk about, an insurance product. Let's talk about a fixed annuity. Fixed annuity is basically a contract with an insurance company which says put on deposit with us X dollars. Let's call it $100,000. And we guarantee, based on the claims paying ability of the insurance company, that we will give you 3% over the next 5 years, annualized. And at the end of this 3 or 5 year period, we're going to give you the principal and we're going to give you your interest. Done. It's a contract with you and the insurance company. So that guarantees your principal as well. It's not FDIC insured, but it's based on the claims paying ability of the insurance company. The other way we can do to protect our capital would be, for example, a CD, certificate of deposit. We put that with the bank. They're going to guarantee that we're going to get a fixed rate of interest. And when the CD matures, we get our principal back and our rate of return. Got that. Now, what's the other thing that we can do? Well, we can buy an individual issue on a bond and hold that bond. And at maturity, we get the principal back. But again, like we've talked about, there's a risk in that to where, A, you may have to pay a premium to get that bond because the printed interest rate is, let's say, 5% on the bond coupon. But the market is going to make you pay more than what that bond is worth to get it back to what the market rate of interest is. So you would pay a bond premium. It's going to yield out to maturity what the market is paying. So be very careful with that. So again, what you need to know when you're investing is what is your actual yield to maturity when I buy this bond? Now, the underlying risk with buying that individual bond is the underlying company may have financial difficulties. So therefore, you would have that risk of principal if that issuing company would go defunct or bankrupt. You may get compromised on your ability to receive back your principal. Got that. What else can we do? Well, the other thing is we can secure a loan via real estate, be the bank. So you may have some money, loan it to a niece, nephew. But again, be very cautious because nieces and nephews, family members think these are gifts. They don't pay you back because they assume that you're not going to foreclose. So that's another thing to consider when you're making these loans to family. Are they loans or are they actually gifts? And, it has a different conception when it's a family member. So investing, what you might need to know. Another thing that we need to consider is your overall risk within your portfolio. When have you actually sat down with a licensed professional and did an objective risk analysis within that portfolio to see if you are on track, or because the market has had this bull run, even with the COVID 30% correction in March of 2020, we survived it. If you stayed in, didn't jump out because of the headlines, then you had a very successful rate of return on your portfolio in 2020. But if you got emotional and you didn't really have any financial strategy, then you jumped out, you reacted, and therefore you didn't know when to get back in, and it cost you that rate of return. So again, investing is that. It is not a guarantee. It is a longer term strategy, and you need a plan. You don't need to react to headlines what you need to do is judge your portfolio, reevaluate your risk profile, and see how your risk tolerance is going. And again, as individuals get older, their risk tolerance usually falls, and that's okay. It's fine. You don't have to be greedy because your portfolio may be of a size that you don't need to expose yourself to all this unnecessary risk. So ask yourself, as a listener here on the Professional Edge, when was the last time that you as an investor sat down with a licensed registered investment advisor and had a comprehensive portfolio review to see if you're on track, see if you're too risky, and see what your overall net rate of return has been? And again, that's taking into account your tax consequences that you have within your portfolio. Again, to start that conversation, give our office a call at 877-654-9798. That number again, 877-654-9798. So investing, what you might need to know is, when can I be done? Well, might be a listener here at 50 years of age, actively working, contributing to the 401k. You may have received an inheritance. You have rental property. You have a lot of things going on, but what does that picture look like altogether? Because you may have an old 401k at your old company that you were going to get ready to roll over. You never got to it because you got busy, and you haven't adjusted that portfolio because, quote, you're in a life cycle fund. Those, we have our own opinion on those, and we would share that with you. We think those underperform, and there's for various reasons that they underperform. They sound great because I'm going to pick the date in which I'm going to retire, and that's going to be my magic potion formula. But when you analyze it, there's some observations that we'll share with you and just say, here's why you might not want to consider putting your entire 401k in a life cycle fund. The 2020, the 2035, the 2045, quote, as you get the longer spread or the later in years, the risk is greater, but not sure that's in a client's best interest. So it all depends on the client's investment horizon, their risk tolerance, and you need an objective analysis of that. So again, investing, what you might need to know is, what is your overall risk in that portfolio? What has been your net rate of return? What is the expense ratios within the fund holdings? These are the details that we at estate management counselors take a look at to help our clients, providing objective financial planning advice and counsel. We have nothing to sell except for counsel and advice. And when our clients win, we win. We have a very vested interest in their success because we are a fee-based advisory. As an RIA, we have to act in the client's best interest at all times, providing that counsel and advice. And being a CPA and a certified financial planner and a tax attorney, then the client is getting this comprehensive advice that's going to them for the overall benefit. Again, to start that conversation, 877-654-9798. That number again, 877-654-9798. So investing, what you might need to know. What else do we need to know about investing? Well, there's risk to it. And with that, what account are you putting your money into? Do you need to put it in your 401k? Do you need to put it in your Roth account? I've talked to numerous people which say, yep, I quote, make too much to put any money in my Roth IRA. Well, that's a first wake-up call. If you've heard that comment, give us a call and I'll show you how to do what is known as a backdoor Roth. You do a non-deductible IRA contribution, then you convert that to a Roth, and that way you can get that money in there because each year the door closes. We can't make up your Roth contribution annually. You got to have some earned income on that as well. And you say, well, my wife stays at home, I work. Am I only eligible for one? The answer is no. You are eligible for two Roth contributions because the earned income of the one spouse attributes to the stay-at-home spouse, so therefore you can qualify, and if you're 50 and older, you can put in $14,000 total, $7,000 each. Or the other part would be, do I put my money in the 401k? Well, we talked about that. Put it in there until the edge of the match is made. The next dollar should go to the Roth. Once we fill the Roth, we go back to the 401k, max that out. If you still have money left over for savings, then we do an after-tax account. So those are the things you investing, what you might need to know. And the other sort of underlying thing is, when we're doing this investing, are you on track? When we make this indication and allocation, recommendations, we have to sort of project going forward. What does this portfolio look like going forward? And are you saving enough money for that safe and secure retirement? The only way you can figure that out is to run the numbers and sit down, take a snapshot where you are financially, take into account what assets you have and what different accounts you have, because you got to remember your 401k is not all spendable. We have to put that through the tax machine, and at best, you're going to lose 25% of that. So if you have an $800,000 portfolio, 25% of that is going to go away to taxes. So a lot of people think that 800 in their 401k is all spendable. No, it's not. It's basically 75% of that account is going to be spendable. So we take into account this spending level and we say, okay, what age do you want to retire? What's your spendable income that you want to have? And we run the math to see if you're on track or whether you're going to be short. It's a great exercise to do. And also, part of investing, what you might need to know is who's the beneficiary on your accounts, because that's going to dictate the tax consequence. We all know putting your estate as the beneficiary on your IRA or 401k is not the right thing to do. So again, putting this all together for our listeners here on the Professional Edge, we put together an incredible offer. It's called The Bundle. You can get the details at emcthebundle.com. That is Echo Mary Charlie, EMC, thebundle.com. And that's where we, being a tax attorney, licensed to practice law, we do the estate planning documents. Then being a registered investment advisor, we coordinate this and we complete your estate plan. That's all done as an investor. We do your investment analysis, your retirement projection to make sure you're on track so you run out of time before you run out of money. And then we also put together the tax plan. So again, check out emcthebundle.com. That is Echo Mary Charlie, thebundle.com. Or you can always give our office a call at 877-654-9798. That number again, 877-654-9798. Schedule your meeting at the Cunningham Center up here in Atlanta, or even that Zoom call. We're okay with that. Like to see the pet, introduce them to us. And we have more coming up here on the Professional Edge.
We've all thought about it. Everyone listening will need one. Not having one can cause untold heartache, family conflict escalating to the point of a lawsuit. One simple thing that avoids all that: an effective estate plan. As a practicing tax attorney, Todd with Estate Management Counselors has completed over 1,000 estate plans during his 15 years of professional practice. He can help you implement an effective estate plan, coordinate your financial accounts, and make sure you have named the proper beneficiaries to maximize your tax savings. Call 877-654-9798 today and let tax attorney Todd help you implement an effective estate plan. Call 877-654-9798 today. As a tax attorney, CPA, for over 15 years, Todd has implemented over 1,000 individual estate plans. He has recently authored an especially helpful guide, How to Unlock the Ultimate Estate Plan. This guide has helped many individuals to understand the benefits of an estate plan and how to avoid unintended disasters. has made every attempt to write this in plain English. To receive this valuable guide, How to Unlock the Ultimate Estate Plan, call 1-877-654-9798 and request your complimentary copy today, or by emailing your request to info@emcadvisors.net.